Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Monday's Stock Play of the Day, we talked about the XLF. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Monday's Stock Play of the Day, we looked at the XLF. That is an ETF that tracks the financial sector. We looked at buying a long in the money Leaps call going out of almost a year in time. In other words, we're going to be a little bit more long-term bullish based off of our forecast. Now, today we're just going to talk about a short-term move that has happened in the XLF. We still have a lot of volatility in the marketplace. The VIX is still up above 20. Going out in time, we're seeing the futures contracts still trading around the 25, 26 level, meaning that we're expecting even more volatility as we get into 2021. So what I'm going to show you here to start with is the actual chart of the XLF. It's a 15-minute chart, and we're going to look at it as of Monday. We always tape the Stock Play of the Day live on Monday at noon Eastern time. So if we go back at that chart on Monday, which was the 11th, here's where the underlying stock was at. We saw it right around 30.80, right? And this is a 15-minute chart. So this is all day Tuesday, all day Wednesday, all day Thursday. So the chart looks fairly impressive, but it wasn't necessarily a large point move to the upside. But we were down around 30.80. Underlying stock ran all the way up to 31.60. Decent move in a few days, but then we've dropped off precipitously, and guess what? We're right back to where we started overall. So what's going on in the XLF? In general, in the financials, we're going to be heading into earnings, and that's one of the things that we mentioned about. But other things that were positive, or that Callie, my colleague, mentioned on the call on Monday, is that interest rates, the long-term interest rates in particular, have been kind of heading northward a little bit. And overall, that's a good thing for the bank. So a lot of people are like, well, if I think interest rates are going to go higher, how can I participate in that movement without actually buying treasuries outright? And one of the answers is look at industries that can benefit from interest rates going up. And one of them are banks. Now, it kind of hurts the mortgage industry a little bit in theory, in that right now the home builders have done well. All the new housing starts have been rocking and rolling. Real estate overall has been strong. But if we get higher interest rates, sometimes that hurts that level. But bottom line for the banks overall, it's better if they have a long-term versus short-term. If we look at that interest rate curve, if we get a little bit of more of a bend to the upside on the long term, that's a good thing for banks. And that's part of the reason why we talked about it. Now, with all that said, it's always, whenever we talk about things on the Stock Play of the Day, it's not meant to be a recommendation. We're only doing it to try to learn what option strategies might fit a specific situation. So if we were longer term bullish on something, and in particular, it's a $30 underlying. The XLF, if I point to it on my chart here, is trading at 30.83 right now. It's basically exactly where it was on Monday. 30.89 is where it was when I captured my screenshot of our paper trade for that week. So with that said, you have fairly tight markets in a lower priced underlying and a liquid underlying like the XLF. So Leaps are an alternative sometimes to be able to manage your downside risk, but still give you a lot of upside. So specifically, we went out approximately a year in time. We're going to go out to the December expiration. We went deeper in the money. We bought something that acts a lot like the stock. That means it has a higher delta. The delta was fairly close to 80 when we bought it. And we put up about 20% of the capital compared to buying 100 shares of XLF outright. So we're basically just renting the stock here, right? We have the right to buy 100 shares of the underlying stock at the 26 level. That was our strike price, as opposed to buying the stock outright. So let's look at that trade. Not much has changed, so it's not going to be an exciting stock play of the day, if you will. Stock is down 61 today, down 2%. That's a fairly decent move to the downside overall. And as I mentioned, next week Schwab is going to be announcing earnings. Not to mention quite a few other banking and financial companies are going to be announcing earnings. So it's more so to see what's going to happen over the next couple of weeks. It should be a little bit volatile because of that, but we've tapped down the volatility a little bit by doing the XLF as opposed to just buying financials outright. Okay, so here's what the trade was. I'm going to roll all the way out. So 336 days out. It was about 340 days when we talked about it on Monday. We saw the stock trading basically right where it's at right now. We looked at buying the 26 strike call option. It was trading right around $6. So it looks like we're down maybe a dime on that trade. 590 would be about where that midpoint is at. And if I open up the option strategy workbench, this is where the trade is at. It hasn't really changed much. Here's our profit and loss graph. We have limited and known downside. So one of the things that if we do this trade, you want to set an alert. You want to know if that underlying stock gets to 26, that's kind of going to be my stopping point. Why? Because if you look at the colored line here, this is if we bought this option contract today, the colored line shows you the profit and loss graph, and it's highlighting that there is a lot of time premium if it comes down to the 26 strike and it's legitimately an at the money option contract and it does it sooner rather than later. You get a kind of a buffer in the fact that it moves a lot like the stock to the upside, but on the downside, all the way down to that 26 level, especially if that move is sooner rather than later, it gives you some protection. That time premium kind of helps you out a little bit. But then obviously if it continues on down to the 20 level, it doesn't give you much buffer whatsoever. You're going to lose the maximum on that trade if that were to happen, especially at expiration. And that maximum would be limited to about 20% of the stock price, or basically $600 to buy one call option plus commission versus buying 100 shares of stock, and we'll call it at 31 or $3,100. So you are limited in your downside. You have a decent market. If we look at this, and I've been emphasizing this on all these FOMO trades, on these fairly liquid ETFs, the market here is a dime wide. Now, the underlying stock is a penny wide, which is ideal, right, to be 1 cent wide. But as far as this market is concerned, it's 10 cents wide. And that's a fairly decent market in a long-term option contract. And that's why this strategy, once again, it's not about the recommendation of the underlying stock. It's all about looking at a strategy that could fit what your underlying, where the market conditions are for your underlying right now. And by market conditions, I mean pricing of the option contracts relative. Okay. So I'm going to show you a leverage covered call, and then we're going to call it a day here. So overall, we talked about buying an in the money long-term option contract, right? Inside the options playbook, we have another strategy that you might consider. It's called a fig leaf. That means a lot of people would like to buy stock and sell calls against it. That's simply one of the most simple option strategy. That's called a covered call. Here, we're not buying the stock, but we're buying something that has a lot of stock price representation. Why not sell a short-term call against that? We can do it if we would like. Here's what the profit and loss graph would look like. It's not hard lines because you have one option contract that expires way out in time, one option contract that expires shortly. But this would be an alternative to a covered call. We nicknamed it the fig leaf, or named the strategy the fig leaf inside the options playbook, because you're kind of covered. We basically were saying that you don't own the stock outright, but you own something that looks like the stock, but it's still not the stock. So if you get called away, you got to do something. And so we came up with the term the fig leaf. A more standard or scientific name, if you would be a leveraged covered call. That you've heard that before. And ideally down on the trading floor, they actually called it a diagonal spread because of the way the quotes were quoted on the floor. Actually, that's why they call it a diagonal spread. So my concept, and I wouldn't recommend this right now. Part of the reason why is that we're going into earnings. So there's going to be some volatility based off of the earnings. If you do this trade right now, you don't get the upside potential because you're capped by doing that short call. but you still have all the downside potential of owning that call option outright. So just keep it in the back of your mind. If I were to look at doing a fig leaf on this trade, I would probably look, we're at 30.80. We have earnings coming in a lot of the financials, but I would look at like maybe selling the 32 strike call against it. Now, if I do this, I'm going to always sacrifice premium to go further out. So in other words, I wouldn't think to do the 31.50 because it's just too close to the strike, and I don't want to be assigned on this trade. I'm trying to just capture that. So that's a little tight. Even though I could bring in 55 cents, I would rather do the 32 or even the 32.50 strike and give up some premium so that I have less of a chance of being assigned. Because if I get assigned, I'm going to have to do something. I'm going to have to either roll it, I'm going to have to stop it, I'm going to have to buy it back, I'm going to have to do something, because I don't want to be assigned on this in particular, which isn't always the case with a covered call, but most of the time with a fig leaf, it would be. Okay. So I would wait and maybe look at that, make sure you would get enough premium overall. My goal when I'm doing fig leaves is to note how much time value is in the long call. How much time value is in the long call. So that's that component that protects us on the downside, but it hurts us over time. It's going to decay. Time is going to go away. We are going to approach expiration. So if I look at the 26 strike call and I just take a peek over at the put, it gives me an approximate time value. This is an out of the money put. This is an in the money call. So we're buying about $1.40 worth of time value. My goal over time would be able to sell enough. If I look back on the chain, the 32 strike, we'll say 40-cent option contracts to offset the decay that is going to happen in my long call option. So if I can do that, then I'm looking really good overall. Now, obviously, we want the market to go up, and you got to be careful and pick your times. So I would wait till after the earnings season, and then I would maybe sell one to try to generate something to try to offset some of the time decay. But I got a lot of time. I got 336 days that I can choose from. That would be an alternative. Now, obviously, you can just buy the call outright and just remain long it, just like you would if you just owned the stock. You can do that, and it would just be an alternative to it. You already have mitigated your risk by buying that Leaps call option as opposed to the stock outright. And I just give you an alternative because I always try to look for alternatives on the stock play of the day. All right, so we're going to end with the XLF at 30.85, 4 cents below where it was on Monday, down 2% approximately on the day. And that's going to be it for the stock play of the day overtime. Now, I have some information for you, so don't run yet. On Monday, it is a holiday. It is a market holiday. So we will not be taping the stock play of the day. And because of these holidays, we've decided that the following week, we're going to actually be moving the stock play of the day till Tuesdays. So every Tuesday in 2021, we're going to be looking to do a stock play of the day. Now, it's going to be at noon Eastern time. You should receive the emails, but you want to make sure that you have clicked subscribe and rang the bell. That way you will get all the alerts as to when the stock play of the day will be. But next week, no show. Week after that, the stock play of the day will be on Tuesday. The overtime will still be on Friday. Thanks for coming, everyone. And we will see you, I don't know the exact date. Not this Tuesday, but next Tuesday. Thanks for coming.